Operating at an extraordinary level can seem challenging. Learn how to survive in the lone wolf economy in the OG Money podcast with Lonnie Ogulnick. Drawing on over 20 years of experience in the trenches of Wall Street, Lonnie explores what it takes to be successful in today's rapidly changing environment. From daily routines, wealth strategies, and sustaining the highest levels of wisdom, Lonnie and his guests unpack proven ways to live an extraordinary life.
Welcome to the OG Money Podcast. I've got Corey Hoffstein, an OG in the quant game, trend following game. He's the CEO of NewFound. Welcome to the podcast, Corey.
Thanks for having me, Lonnie. It's a little disheartening to hear I'm an OG in the quant game at this point. I used to be the young kid. Guess I'm getting older now, huh?
Yeah. I mean, you survived, right? I mean, how many people have not survived? Think about like what we've been through since 2000. You were in college. What year did you graduate?
2009, I graduated.
And where did you go to school?
So undergrad, I went to Cornell University for my computer science degree, and then I went right to Carnegie Mellon's graduate program for computational finance for my master's right after that.
So computational finance. So explain to the audience what exactly that means.
Yeah, so computational finance is another name for a financial engineering degree. So it's this interdisciplinary study between computer science, mathematics, and finance. And most people who go through that program would have ended up working at a Wall Street bank on a major sales and trading desk, helping to price or structure different derivative products. And obviously, after 2008, all those desks disappeared. So most of us had to end up finding other jobs elsewhere. But you can sort of think of it as you're a quant. You used mathematics to evaluate financial markets in different ways.
So what brought you into the world of trend following, and what makes your special sauce different or better, and why do you stick with it no matter what happens? You just rely on it. And I mean, you've been talking about deviating a little bit of late, but for the most part, you've stuck with a true and tried formula. And why?
Trend following is something that I came upon pretty organically back in 2006, 2007. I remember one meeting in particular that I had in 2007 back when I was interning, actually. I was interning for a financial advisor, and I was sitting in on PM meetings. And Lonnie, I'm sure you have these meetings all the time with PMs, and they come in and they talk about their views on the market. This was summer 2007. I was sitting with a small cap manager, and I asked them what their thoughts on the market were. And this person gave me the most bearish prognostication of the markets I'd ever heard. And again, I was young at that point, and until then, it had been a bull market. And it was just this view that markets were in for a massive bear market, something I hadn't heard yet. And I asked them what they were going to do with their portfolio. You have this hugely bearish view, and the person responded, I run a small cap mutual fund. My job is to be 100% invested at all times. If the advisor doesn't think the risk is right for their clients, it's up to them to take their money out. At the end of the day, I don't even know who's investing with me. And I said, that makes sense. And so after the meeting, I asked the advisor I was interning for, I said, well, here was the question, here was the answer. What do you think of that? And the advisor said, well, how am I supposed to know when it's a right or wrong time to be in small cap stocks? Isn't that what I'm hiring an expert for? And I just sat there and said, I don't see anyone managing my risk the way I think about risk, which is preservation of capital. And so it sent me off on this long journey of trying to find all these different ways that I thought I could potentially de-risk my portfolio, utilize cash as an asset class, and ultimately try to protect my net worth during periods of significant market dislocations and drawdowns. And through a lot of different sort of exploration and reading and research and trial and error, trend following, this really basic idea that stocks or asset classes that are going up tend to keep going up, and stocks and asset classes that are going down tend to keep going down, really just stuck out as a methodology that had proven to be incredibly robust over decades and decades and decades of data across all these different asset classes. And I said, this is the approach that I really want to build my portfolio around. And so that's really what I started back in 2008, and is something that I continue to preach today, because I think there are just properties of that type of exposure that most investors can benefit from if they incorporate it in their portfolio.
All right, let's dig in right now then. We have a zero interest rate environment. My thought process is the Fed can't raise rates. They can't even discuss unwinding their bond buying, which is $1 billion a month bonds, mortgages, and then God knows what else. But it seems like we have this other storm brewing, which is higher taxes across the board. And it seems like the stock market today, literally today, but I would say more or less the last week or two, with commentary coming out of, whether it's Janet Yellen or Biden's tax proposal, the markets come out of nowhere and just drop 2, 3, 4% on the NASDAQ, individual stocks 8% in a day. Is this the start of a bigger correction, or is this more of the same garden variety? They'll come in and buy them up shortly because rates are zero and there's nowhere else to go with money. Because historically speaking, I think the big, mind-altering blow-ups have come when the Fed's raising interest rates, whether it was 2000 to stem the bubble in tech, whether it was in 2007 to stem the bubble in real estate, or it was raising rates right before COVID and they had to come to zero. Do you know of a time in history where markets unraveled and crashed almost in a zero interest rate environment, other than the taper tantrum in 2013? I mean, there were some rough years, especially for trend following in those Obama years. I remember those.
I think what's really unique about this particular environment we're in is that your pain within the market is really driven by what pocket of the market you're invested in. High level, the S&P is still near all-time highs. I mean, if you're just looking at the S&P 500, it's having a very strong year. And yet, as you point out, there are pockets of the market that are down 30 to 50% from all-time highs. These growth names in particular. And what we're seeing today, what I'm seeing when I look at sort of what I would call the cross-section of the market, how's one group of stocks doing versus another, is it is one of the most volatile periods ever in the history of all the data I can look at. When you look at sort of this cross-section of what's going on, growth versus value, junk stocks versus high-quality stocks, small cap versus large stocks, these cross-sections usually move in a distinct manner, but not as violently in their dispersion as they're moving today. And that makes this market environment particularly unique because you have investors who are feeling really acute pain. To go back to a point you made about this, look, we have had zero interest rates for nearly a decade, and then you had a huge amount of monetary and fiscal stimulus enter the market. That money has to go somewhere. And one of the things we saw last year was you had retail investor participation skyrocket in the market. We see it in crypto, we see it in the options market, we see it in penny stocks, and in a way it's sort of this moving blob of money. There's only a fixed amount, but it is incredibly explosive when it sort of focuses its eye on one area. GameStop is a really good example of that. Retail participation piled into GameStop. It invited a bunch of institutional participation, don't get me wrong. There's a lot of hedge funds that joined it in there as well. But that sort of retail catalyst really kicked off a tremendous amount of volatility in that name. If we look at other names that retail was really heavy into in Q4 last year and early Q1 this year, a lot of those names in particular have been under tremendous pain. And I think part of that they just probably overran their valuation. They were up hundreds of percent last year, probably far beyond where fundamentals could reasonably justify them going. And so they're taking a breather, but because that run-up was so explosive, the breather is equally painful on the downside. Whereas other stocks that had sort of been unloved throughout all last year are sort of bouncing back up, maybe more towards fair value. And so you're getting this huge violent rotation, this undercurrent within the market that is really painful for a lot of people. And yet at the top level, it remains very placid. So it's tough to say whether that undercurrent bubbles up to the top and the market high level becomes much more volatile, or whether the top level stays calm and we really have to beware of all these violent undercurrents.
Yeah, so you got the big boys, right? Like the FANGs. So Amazon and Facebook putting up numbers that are just mind-boggling. Apple. We always look at like the bottom of the stock market when I see that the news is so bad that stocks start going up on bad news. Is the market pricing in the fact that those numbers are not going to be able to be replaced in the future and we're selling off on really good news?
It does seem like we're at a situation where, with the FANGs in particular, I think most people would be surprised to say that as a group, as a basket, they've really gone nowhere since last August. They've mostly traded sideways. Amazon has traded largely sideways. I think there is a market expectation that there has been this big injection of capital. We expect a huge amount of pent-up consumer demand to flow through consumer goods. We expect blowout earnings, but they're not sustainable blowout earnings, right? So we're not saying, oh, these are blowout earnings and we think the company is going to do better in perpetuity. This is probably a one-time short-term jump in earnings. And therefore, we need to make sure that our future expectations for the company remain at sort of long-term trend. So I think what I would expect to see in the short term is really abnormal off-trend reporting, both positive and negative, and going to get discounted by the market in both directions.
And how much of the S&P derives of those big names that like Apple and Amazon?
Tremendous amount. I mean, you're talking your top 10% make up 30-40% of the S&P.
Right. So if those do roll over, if we're seeing a trend in those big names, and the S&P is going to start to roll, they're going to feel it. So when it comes to your trend following, right? Me and you can have a conversation. We can start thinking and see things. How far off is the trend following ETF strategies that you're in from what you're thinking?
I would say it probably, that's going to vary year to year. The one thing I've learned over time is that no matter what I'm thinking, I'm normally wrong, right? And that's one of the reasons I value being systematic. I remember the lessons of 2012, 2013, hearing all of these people who had gotten out towards the bottom of 2008 and were just too scared to participate in the market, and they missed out on years of gains. And I did hear that to a certain degree last year. Now, trend following strategies had a tough rebound. The market sold off so violently and then rebounded so strong, they were delayed getting back in. But I was still talking to market participants last August, last September, who were saying, no, I think the market's going to keep rolling over. Systematic strategies certainly help keep you in. My view is it would be very difficult for the market to completely roll over here without some sort of catalyst, right? There is so much pent-up consumer demand that if you look at the excess savings on consumer balance sheets right now, it's like if that were all to be unleashed upon the market, it's several trillions of dollars, right? We look at consumer, how they're feeling from a household balance sheet perspective. Consumers are wealthier than they've ever been, particularly the investment class. And that's why you're seeing prices of weird collectibles go up so much, whether it's watches or art or scotch or wine or really even really esoteric stuff. You're seeing demand for these types of assets because people are feeling wealthier than they've ever been. You don't typically get a market rolling over violently in a situation where there is such strong consumer behavior. You typically would expect the consumer behavior to be somewhat of a leading indicator to what's going to happen with future earnings. And so with the consumer being so strong, we would expect strong future earnings, which is a buoy to the fundamentals of the market.
Okay, well, since you're typically your opinion, you just said,
It's wrong.
yeah.
Typically wrong.
Well, I would say it's not wrong, but it's dead on. My question to you would be, because there's so many people now in the trend following category. I am, since the day I started, an IBD disciple, and the trend is your friend. It has been my mantra forever. So we've seen a proliferation of trend following strategies like yours, and what I often think about is how they've gotten very long in the tooth on the upside. And we got a glimpse of what can happen in March of 2020 for the first time on the downside, and how fast we can flip from long to short. And then who's the buyer, right? The momentum on the upside has an inverse correlation, and we often use a leverage strategy to the downside when they do flip. My concern would be the rollover that we will see when it does happen. How do you contain that forest fire?
Well, I think that's spot on, Lonnie, and something I thought a lot about last year. The proliferation of systematic strategies after 2008. There was huge demand among investors for different types of diversifying strategies that could protect them from another 2008. If we take that to an extreme and just say everybody is suddenly implementing a trend strategy, and markets start to roll over, and every investor out there decides they want to sell, and to your point, there's no buyers, price is going to violently collapse faster than it's ever collapsed before. And so the more you have people all using the same strategy, the more concentrated people are in that strategy, the less the strategy can work. I don't think there's abnormal concentration in trend following, but I do think there's a bunch of correlated strategies to trend following that have become crowded over time. So for example, post 2008, a lot of insurance companies started offering variable annuity structures that were tied to what are called target volatility indices, which basically means as the market gets more volatile, they'll de-risk. If the market's less volatile, they'll take on more risk. Well, it's not trend following per se, but it's going to be very correlated to trend following because markets tend to get more volatile when markets are going down. And so you have people allocating to all these different approaches that are correlated. I do think that means that when there is a sell-off, unless the market structure changes, those sell-offs are at risk of being more violent. We saw a little peak of that, I think, in December 2018. You remember right before Christmas, that week before Christmas was like, the Grinch who left coal for all of us in the market. It was just a quick, violent sell-off. And then March 2020 was really just one of the most outlandish markets for anyone paying attention to what was happening with market microstructure, where there was just no buyers, right? And that's a very, very dangerous market to participate in. And so for me, thinking about, well, what does it mean for trend following going forward? I don't think it necessarily means trend following is broken by any means, but it does go back to core concepts I've long held, which is, right, trend following should be a piece of what you do, that there's certain market environments trend following will work well in, and there's certain market environments like a March 2020 where it's such a violent sell-off and such a violent rebound that unless you're doing very, very, very fast trend following, sort of front-running all the other trend followers, it might not be the best environment for it, but there might be other strategies at your disposal that you can complement with trend following that could become buyers, like mean reversion strategies, or even just as simple as something as rebalancing your asset allocation could have you selling bonds at the bottom and buying stocks when they're sold at discount.
Yeah, so I think the buyer, how much influence do you believe that the government now plays in the market as the buyer of last resort? Like, I saw they've got a nice size position in LQD and the high yield bond ETF. So would the Fed have no problem if they felt the market was coming down, just get in there and start buying up the market just to keep the trend going? Because I don't think that they have much pain tolerance at this point.
I think one of the things that's changed fundamentally in the market over the last 30 years is the degree to which the market and the real economy are linked. Now, what do I mean by that? Well, like, stocks are always supposed to be based upon, right, future earnings. It should be tied to the fundamentals of the company. What I mean is that over the last 30 years, we have seen savers, investors begin to use the market as a savings vehicle, right? When interest rates go from 6% to 0, who's going to keep money in their savings account anymore? We've seen target date funds, right? These sort of market-driven savings accounts grow from under $10 billion in assets in early 2000 to nearly $3 trillion in assets today. So what happens when people aren't using their savings account anymore, but they're using the market as their savings account? And all of a sudden the market gets really volatile, or the market drops 30 or 40%, and they see their long-term savings get wiped out by 30%. Well, that's going to have a very real impact on spending behavior. And so I think the danger that we're in today is that if central banks allow markets to crash, it ultimately has very real knock-on effects, pro-cyclical knock-on effects, in fact, into the market, because those investors are going to be less likely to spend, which is going to further hurt the earnings of the companies whose stocks are ultimately being priced in the market. And so I think central banks are in a really bad place. I don't know if they can step away from markets wholesale until they've gotten rates back to a normalized level. But I don't think we necessarily have the economic growth or productivity or demographics to support higher rates.
I don't see rates going up ever. I think we're Japan.
I think that's a very real risk. And so the question becomes, how do you begin to allocate in an environment where central banks have moved from referee to very active player, right? So perfect example, March 2020, they took the playbook that they developed in real time from December 2007 through December 2009, right? It took them 2 years to develop this playbook, and they pretty much did the entire playbook plus more in 2 weeks in March 2020. And did it to like the nth degree in terms of size, right? The amount of trillions of dollars that were unleashed onto the economy. You can't say that central banks aren't having a huge impact on markets. They absolutely are. They are a very active player. And so I think for all of us investing, it brings up very natural questions of, well, if they're the buyer of last resort and we know that there's a Fed put, why wouldn't we just always be long and strong, right? There might be some bumps along the way, but the Fed's going to bail us out, right? Fiscal policy and monetary policy is going to bail us out. Why bother doing anything but the riskiest trade there is?
Well, that was the macro playbook for 30 years, where Stanley Druckenmiller and the boys just levered up the long bond as much as they possibly could because they knew that the Fed was going to come in and lower rates. So the juice has been squeezed out of that lemon. So it's almost like, okay, has the S&P or to a degree the FANGs become that new macro play? And then Bitcoin coming into its own over the last, 2-3 years now, and Ethereum and all these different, DeFi and Uniswaps. What are your thoughts on Bitcoin? Do you believe it's digital gold and will replace gold, or do you believe it's a fad blip on the radar and sell it while you can because, it'll be gone just like, in what happened like 4 years ago? What camp are you in?
I think full disclosure is necessary here. I do own cryptocurrencies. It's probably about 1% of my net worth, so I'm not wildly in, but I should disclose I own Bitcoin, I own Ethereum, I own a smattering of other alternative cryptocurrencies that I think are interesting projects. I think we're still very early days. One of the things that I think is most curious is that this won't die. Cryptocurrency has been around for 7, 8, 9 years and refuses to go away. I don't think there's ever been an industry, there's no industry in the history of mankind that I can think of that so much human capital has been poured into so much brain power, so much idea generation, so much creativity that ultimately ended in nothing without creating anything, right? You think about people who have totally upended their lives to work in the cryptocurrency universe. I mean, their entire business is built around this space. It would be very weird to me if nothing ultimately came out of it. I don't know if I have the particular insight to say what is going to come out of it, but I look at a small allocation to some of these projects as basically saying it's sort of a long-term lottery ticket to me, that there might be something very powerful here. It might take another 20 years to emerge, and it might be winner take all. Maybe it's not Bitcoin. Maybe Ethereum surpasses Bitcoin and Bitcoin is version 1. Or maybe Cardano surpasses Ethereum and both Bitcoin and Ethereum go away. I sort of look at it as if I can diversify myself and rebalance into recent market winners and just sort of stay market cap allocated. It's my way of participating in the space. And again, at a size that I don't think is unreasonable given sort of the total market cap that the space represents relative to other global assets.
Yeah. I often think, I remember there's a couple of times I remember Amazon at 9 after going to 120, and that was a good buy. I also remember gold, like they're like, oh, we're launching a gold ETF. And do you remember what happened to the price of gold after that gold ETF was launched? It was like 2003, 2004. Yeah, it was hyperbolic tear. And if you had to ask me, that is the exact reason the SEC has not yet approved an ETF. And, you know, from the retail side, we don't have any access to Bitcoin. I'm not going to buy GBTC. Square Capital's probably, you know, a great. There's several companies that are, you know, putting balance sheets on or just involved in the space that you can get exposure to. But what I think will happen is every bank from UPS to JP Morgan to Morgan Stanley to Goldman Sachs is now like, oh my God, there's major demand from the client base, and they got to figure out real quickly. But how do you, like, I often laugh, like Coinbase came out of the gates almost the size of Goldman Sachs, while all the legacy banks just sat around and like watched this behemoth take over the space. How did they miss that?
I often wonder whether it's a bit of hubris and a bit of regulatory caution, right? It's a lot easier for a startup to take all the regulatory risk than Goldman Sachs. And you would think Goldman Sachs has the lawyers to deal with the regulatory risk. But I think it's the same reason that you end up, you know, Uber's a startup and they sort of put their middle finger up to all the taxi regulations and they say, come get me. I think to a large degree, a lot of these innovations have to come out of startups that are willing to sort of outrun the regulators. Not to say that Coinbase is doing anything wrong, but I think firms like JP Morgan and Goldman Sachs are going to worry much more about the downside of introducing a potentially new volatile asset class that you never know which way the regulators are going to go.
And I don't think it's in their best interest if it's successful anyway, like as a bank, right? Like Square's built a bank around the Bitcoin, and I just don't see how, you know, T0 settlements and $5 for wires, and I mean the whole thing is so disruptive. Back to trend following, though, it seems to be that's the hot trend right now. If you gave me a 6 to 12 month window, what do you think the trends are outside of Bitcoin? Right now, we're starting to see the reemergence of oil and gas, right? Is that a short-term blip on the radar, or is it going to continue to be the big tech names, the software that's eating the world? I know Kathy Wood's ARK funds are down 30+% in the last couple of months. Is that going to see maybe another 5-10%, but then it's time to start buying those, you know, AI? She's in a little bit of everything that, you know, pretends to be the future. Like, where do you see all these trillions of dollars really, you know, focusing in on?
We're seeing really explosive trends in the commodity space. A lot of people would say, hey, this is inflation-driven concern. I think it's a mix between, right, you have positive demand shocks coupled with negative supply shocks from COVID disruptions to all these supply chains you get this sort of disruptive bullwhip effect that minor perturbations from the consumer can blow way out once you go up the supply chain to the actual producer as to how much they're making at any given time. It's very hard to navigate that. And that's going to take a while, I think, to ultimately stabilize. And so you're seeing lumber prices explode. You're seeing all sorts of commodity prices absolutely explode. But I think what that also points to is the nature of those markets. Something like the lumber market, for example, which has really been in the news, lumber futures are very illiquid. Just the nature of that market is they tend to spike up like crazy. They tend to spike down like crazy. And so I think the expectation would be, assuming consumer behavior doesn't change, you could continue to see these trends go parabolic, but they're going to be very, very volatile just on the nature of those markets. I'll jump to Cathie Wood, because I think that's a really interesting sort of opposite example where the nature of markets can start to work against you. Cathie, for those who don't know, has built this absolutely enormous investment company, ARK Investments, after years and years and years of hard work. I think she's north of 35 billion now, or at least was at peak. And towards the end of last year was taking in hundreds of millions of dollars a day into her ETFs, as well as her separately managed accounts and her mutual funds that she's sub-advisor with Nikko Asset Management. And what's unique about Cathie is not only does she try to invest in these long-term disruptive themes, but she's very willing to take very large ownership stakes of companies. So across her SMAs and ETFs and mutual funds, she might own 30% of a company. And so here's the fundamental problem. When you start to see a dramatic amount of money flow into your funds, and you are a 30% owner of these underlying companies, you've already eaten up a ton of the supply. And so as supply disappears and demand increases, well, it's just basic economics, the prices are going to go parabolic. And here's where it gets pretty interesting, is if her prices of the stuff she owns starts going parabolic, it makes her performance look better, which invites more flow into her funds. So it becomes sort of a self-fulfilling prophecy that her performance skyrockets. Eventually, the marginal dollar isn't able to keep the prices going up anymore, though. And that's when the unwind can happen the other direction. That is, you start to see outflow because she's the biggest owner and there's no real demand for these companies. Just people had demand for Cathie and her ETFs, that you start to see really dramatic drawdowns in some of the names that she's in. So I think, assuming that flows are pro-cyclical, that inflows invite more inflows and outflows invite more outflows, Cathie and by proxy, the names that she's in could be in for some more pain. But if those outflows stabilize and things sort of go back to normal, I think the ship sort of stabilizes there. So it's, again, what's interesting to me is that this is a market environment. I'm going to steal a quote from a Bloomberg reporter, Tracy Alloway. She said, this is an environment where it's really flows over pros. We're all raised around this intrinsic value, Warren Buffett, buy value companies. And this is a market environment that has almost nothing to do with intrinsic value. It's just, where is the flow of capital going? Is it retail buying up call options in Tesla, driving Tesla up into the S&P 500? Is it Cathie Wood, all the flow going into her ETF, buying these non-profitable tech and EV names? Is it Cathie announcing she's going to launch a space ETF and related stocks jump 15-20%? That's not really anything having to do with fundamental value of cash flow anymore, and everything to do with just, where's the flow of money in the market? There's so much money now trying to find a home that's been injected in the system. I think it's causing some short-term chaos.
Speaking of quotes, I know you have a podcast. What's the name of your podcast?
Flirting with Models.
So, Flirting with Models, which I happen to listen to. I just forgot the name of it. I see your face on it, so I click. You've spoken to a lot of smart people. Who's the smartest guy that you've, or woman that you've interviewed, and what was the takeaway from them that you remember the most that's stuck in your brain?
I've spoken to, so I do it seasonally, and I'm on my 4th season. And I think what's scary to me when I do this podcast is how many incredibly brilliant people there are operating in different pockets of the industry. I'll talk to a Ben Eifert from QVR Investors, who runs an absolute returns hedge fund, who is looking at things like dividend swaps and understands when banks are hedging structured products and creating illiquidity in the dividend swap market, and he knows when to buy those and hedge it with S&P exposure. It's just a unique view based on experience and deep understanding that few people have. And then I'll talk to someone like a young guy, Sam Trabucco, who works for a firm called Alameda Research, who is in the crypto space, and they run a crypto hedge fund, and he was running a triangle trade where they were literally buying Bitcoin in the US, sending it to Japan, selling it on a Japanese Bitcoin exchange, sending that money to a Japanese bank, having someone go to the bank every morning right when it opened, so that in the first 20 minutes they could wire it from the bank in Japan to a bank in the US and start the trade all over again. And to figure that trade out, they literally had to have someone on the ground in Japan. And to me, it's not who is the individual smartest person. I think what the podcast has really made very potent for me is how many brilliant operators there are in this industry who are carving out a niche for themselves by truly understanding very particular pockets of the industry and becoming really strong experts in those pockets. So I think as fun as it is to talk about all the different things that are going on in markets, the thing I see time and time again is the people who really walk away making a lot of money are the ones who have a very particular strong view in a particular area. They know their edge and they're able to exploit it perfectly.
Speaking of flirting with models, you were flirting with some changes earlier in the year. Did you decide against that? Are you still playing around with numbers? What are you? Where are you at on the changing up what you've done for the last 10 years?
Yeah, so March 2020, I think for most trend followers was a big wake-up call as to how violently markets can rebound. What we ultimately elected to do with some of our mandates was say, we have a fundamental belief that markets are going to continue to exhibit extremes to both the upside and the downside. And the best way for us to try to structurally prepare for that is by introducing positions that will do really well during extreme market environments. And so, for example, for really, really strong positive market environments, we might buy out-of-the-money call options, which, if you don't know what those are, just think of them like lottery tickets. They're not going to pay off most of the time, but when the market's really good, they're going to pay off big. Or for down markets, we might buy out-of-the-money put options. And again, if you don't know what those are, you can just sort of think of them as like insurance. You're paying a premium most of the time, but if the market's down big, it can pay you off to help protect you. And so we have made some of those changes in some of our mandates. For some of the pure trend following mandates, we haven't made those changes yet. It's really a matter of, for example, like in the mutual fund we run, we can actually go to the market and build the exact structure we want and buy the underlying options. In separately managed accounts we help run with models that we deliver, we can't always buy that type of exposure. And so it's about trying to figure out what's the next best proxy and make sure we're not just making the changes for the sake of making changes, but make sure it's actually a long-term structure that we want to have. So we're still working on those. In the meantime, those trend strategies, particularly like our levered ones, have been having a phenomenal run sort of Q4, Q1 this year. And
yeah,
so probably better we didn't make any changes.
Yeah, and I've learned to, and I think my clients as well, have learned to live with knowing there's going to be some choppy years, but when they're good, they're really good, right? So, I don't think any strategy works all the time. So, like you said, a little bit of maybe 2 or 3 or 4 different strategies, depending on your risk tolerance, is a good scenario. And I like to leave off the podcast with, do you have a question for me?
So my question for you, Lonnie, is you've been doing this for a long time and you've been seeing a lot of markets. And I know, as you mentioned, that you're sort of an IBD disciple. You're a long-term sort of growth, but growth with a positive trend, right? You've always been about that capital preservation. Is there anything you've ever seen in markets that would shake you out of that sort of long-term approach that you've taken?
So I would say, as a retail financial advisor, my vision and what I can see often is at odds with what the client sees, right? So in today's world, we're seeing, apps that you can look at your account 4 or 5 times a day, a week, and the emotions involved in that are unlike anything else. The only reason why a real estate investment has worked over 30 years is because, if you wanted to sell, you couldn't, right? So historically, these investments that tie you up for 7 or 10 years, these private equity deals, everyone's like, oh, private equity's great. Real estate's great. I never make money in the stock market. It's because the emotions involved, whether it's my emotions or your emotions or the client's emotions. Again, I tend to not worry too much when interest rates are zero because I always say, where are you going for a 10-year treasury at 1.5%? Not really too interested. I would not like to see this 43% long-term capital gains tax get implemented. I think the market would be okay with 28 or something, but you just don't want to see the animal spirits leave the market, and you're starting to get a sense that's happening right now because of these ideas. So I think we're in a little bit of a box. I'm thinking that nobody on Capitol Hill wants to see the markets melt down, right? No one in the Fed wants to see the markets melt down. So maybe they'll come to their senses. I remember, Obama, on the campaign trail talked a big game, but, settled on, some reasonable ideas. I just want to see, whatever happens be settled upon, let the market understand what they're dealing with, and then we go from there. As far as the amount of money that's being flooded into the system, I think that the reality of people who are in the market right now making 3% a year, 4% a year, 5% a year in your standard asset allocation or models or however you're getting 5% and you're happy with that, the reality is the 15% monetary printing presses, should we say, anything below like 10 or 15% a year, you're really losing net worth every year. So we don't have any choice but to go out on the risk curve and try to outperform because I had a Haagen-Dazs ice cream. It cost me $9.20 yesterday. And I was like, thank God I didn't get the 3 scoops. I only had a $10 bill, right? Like $10 for a Haagen-Dazs ice cream cone. Like it's insane, right? So I don't think my thought process is that people get caught up in like, I'm 5% and I'm happy. They don't understand that 5% is losing, So my job's hard because I have to go out there and find riskier assets, tell clients we got to take a little bit more risk, which means more volatility. But in the long run, the volatility is the price you're going to pay for performance. It's whether or not you can stomach the volatility or not. So with that, I appreciate it. And we've been talking about getting you on for a little while. I'm glad we had this wrap up. It's always good to hear from you. Every year we do a little get together down here. So I know COVID knocked us out this year, but we're going to get you down to Miami sooner rather than later. As soon as people, as soon as people are fully vaccinated and we're all set. So thanks for your time. I appreciate you. And where can people find you if they want to follow you?
Well, thanks for having me on, Lonnie. You can find me on our website, thinknewfound.com, or I am on Twitter far too often at Hoffstein.
All right, great. Appreciate you.
Thank you for listening to the OG Money Podcast. Click the subscribe button below to be notified when new episodes become available.
Securities offered through Securities America Inc., member FINRA SIPC. Advisory services offered through Securities America Advisors Inc., an SEC-registered investment advisor. This site is published for residents of the United States and is for informational purposes only and does not constitute an offer to sell or a solicitation of an offer to buy any security or product that may be referenced herein. Persons mentioned on this website may only offer services and transact business and/or respond to inquiries in states or jurisdictions in which they have been properly registered or are exempt from registration. Not all products and services referenced on this site are available in every state, jurisdiction, or from every person listed. Third-party comments may not be representative of all customer experiences.